Every trader believes their bubble is different. Every investor swears. This time the fundamentals justify the prices. And every single time, human greed transforms rational markets into delusional gambling dens. In 1637, the wealthiest nation on earth watched its economy nearly collapse because of flowers, not gold, not land, not armies or trade routes, tulips. A single bulb sold for the price of a mansion. Merchants abandoned their shops to trade flowers they'd never seen. Farmers mortgaged their land to buy contracts for tulips that didn't exist yet. An entire nation convinced itself that colored petals would make them rich forever. Rome fell to barbarians, Spain bankrupted itself on war, Britain would later crash on South Sea stock. All of them followed different paths to ruin. All of them ignored the pattern forming beneath their feet. And in 1637, Amsterdam, the world's first recorded financial bubble, inflated, popped, and left a generation devastated. But here's what makes Tulip Mania different from every crash that followed. This wasn't caused by corrupt banks or government manipulation or corporate fraud. It was pure, undiluted human psychology, greed, fear, and the desperate belief that this time the laws of economics didn't apply. The question isn't whether you believe people could be that irrational over flowers. The question is whether you recognize the same patterns playing out in markets today, because the psychology that destroyed Dutch fortunes in 1637 never went away. It just found new assets to inflate. Because when an entire nation decides that a tulip bulb is worth more than a skilled worker earns in 10 years, you're not witnessing a market anomaly. You're watching human nature destroy itself. To understand how tulips nearly destroyed the Dutch economy, you need to understand how powerful the Dutch Republic had become by the 1630s. This wasn't some backwater economy ripe for irrational behavior. This was the world's financial superpower. The Dutch East India Company. The VOC was minting fortunes. Dutch ships dominated global trade routes from the Spice Islands to the Americas. Amsterdam's merchants were the wealthiest in Europe. The Dutch Republic had broken free from Spanish rule and was flexing economic muscle that made older empires nervous. By 1630, Amsterdam had become the banking capital of the world. The Amsterdam Exchange Bank pioneered modern financial instruments. Letters of credit, futures contracts, and derivatives were all invented or perfected by Dutch financiers. This matters because Tulip Mania didn't happen in an unsophisticated economy. It happened in the most advanced financial market of its era. These weren't ignorant peasants being conned. These were experienced merchants, traders, and financiers who should have known better. But wealth creates problems of its own. When a merchant class suddenly has more capital than investment opportunities, they start searching for new places to park money. Traditional investments, land, shipping ventures, government bonds were already saturated. Enter the tulip. Tulips had arrived in Europe from the Ottoman Empire in the mid-1500s. They were exotic, beautiful, and most importantly, rare. The Dutch climate proved surprisingly good for cultivating them, but growing tulips remained difficult and unpredictable. Here's where biology created the conditions for mania. Tulips occasionally contracted a mosaic virus that created stunning color patterns. Flames of red, streaks of white, dramatic variegation. These broken tulips were spectacularly beautiful and completely unpredictable. You couldn't intentionally create them. You had to wait and hope your bulbs would break into desirable patterns. This randomness transformed tulips from flowers into lottery tickets. Wealthy Dutch merchants began collecting rare tulip varieties as status symbols, owning a semper. Augustus, the most coveted broken tulip, signaled wealth and taste. Gardens became showpieces. Tulip collecting became the hobby of the elite. Now here's where it gets controversial. Some historians argue Tulip Mania was overblown, that prices weren't as insane as commonly reported, and the crash didn't devastate the economy. Others insist it was exactly as catastrophic as the legend suggests. I lean toward the latter because contemporary accounts, legal records, and economic disruption all point to genuine crisis, not just inflated folklore. But I want to hear from you. Drop a comment. Have you studied financial bubbles? Do you think Tulip Mania was real economic disaster or exaggerated myth? But around 1634, something shifted. Tulips stopped being a luxury hobby for the wealthy and became a speculative investment for everyone. The transformation happened gradually, then suddenly, exactly like every bubble in history. First, professional growers began offering tulip futures. Since bulbs could only be planted in autumn and harvested the following summer, traders created contracts to buy and sell bulbs that were still in the ground. This made sense for legitimate growers and buyers who needed to plan ahead. But futures contracts created something dangerous: the ability to speculate on tulips without ever touching an actual flower. A contract changed hands multiple times before the bulb ever left the ground. Speculators who knew nothing about horticulture began trading tulip futures purely for profit. The underlying asset, the actual flower, became almost irrelevant. Sound familiar? This is the exact same mechanism that inflated the 2008 housing bubble, when mortgage-backed securities traded far removed from the actual homes they represented. By 1636, tulip trading had moved from elite gardens into taverns. Yes, taverns. Regular gathering spots became unofficial tulip exchanges where merchants, workers, weavers, and craftsmen gathered to trade contracts over beer. These weren't formal exchanges with rules and regulations. These were drunk men in bars betting on flowers they'd never seen, using money they didn't have, based on prices that bore no connection to reality. The mechanics were simple but insidious. A trader would buy a futures contract for a specific tulip variety at a certain price. If prices rose before the contract came due, they'd sell it to someone else at a profit without ever handling the bulb. If prices kept rising, that buyer would sell to another speculator, and so on. This created a chain of obligations where dozens of people might claim ownership of the Amay bulb before it ever bloomed. Let's talk numbers, because the price appreciation defies belief. In 1623, a single Semper Augustus bulb sold for 1,000 guilders. That was already expensive, roughly what a skilled craftsman earned in a year. By 1625, the same variety sold for 3,000 guilders. By early 1637, Semper Augustus bulbs were trading for 5,500 guilders each. To put that in perspective, a nice house in Amsterdam cost about 3,000 guilders. A ton of butter cost 100 guilders. A skilled worker's annual salary was around 250 guilders. One tulip bulb, 22 years of skilled labor. One tulip bulb, nearly 2 houses. One tulip bulb, 55 tons of butter. But even those numbers don't capture the true insanity, because the most dramatic price increases happen in the final months, between November 1636 and February 1637. Just 3 months, tulip prices increased 5-fold, then 10-fold, then more. Rare varieties that had sold for hundreds of guilders suddenly commanded thousands. Common varieties that anyone could grow started selling for what rare bulbs had cost months earlier. A pound of ordinary tulip bulbs, not even premium varieties, sold for 1,500 guilders in January 1637. The acceleration was exponential. Every week, prices climbed higher. Every day, new buyers entered the market, terrified of missing out. Every transaction validated the insane valuations and encouraged even more reckless speculation. Historical records document transactions where tulip bulbs traded for 12 acres of land, a complete brewery, a bed, complete furniture set, and 2 loads of wheat, 1,000 pounds of cheese, 4 oxen, 8 pigs, 12 sheep, 2 barrels of wine, 4 barrels of beer, 2 tons of butter, and 1,000 pounds of grain, all for a single viceroy bulb. These weren't apocryphal stories. These were recorded transactions with witnesses and legal documentation. If you've personally experienced a financial bubble, crypto, housing.com, anything, drop a comment. What did the final stage feel like? When did you realize prices had disconnected from reality? Your experience matters because human psychology repeats across centuries. But here's what made the mania sustainable for as long as it lasted. Prices kept rising. Every skeptic who said tulips couldn't be worth 5,000 guilders was proven wrong when they sold for 6,000 the next week. Every cautious merchant who refused to participate watched their neighbors get rich. Every rational argument against tulip speculation was drowned out by the undeniable fact that prices were climbing. This is the cruelest aspect of bubbles. They punish rationality and reward insanity right up until they don't. The justifications people invented to explain the prices sound absurd in retrospect, but made perfect sense at the time. Tulips are rare and will always be valuable. The Dutch Republic is wealthy, and growing demand will only increase. Tulip cultivation is difficult, supply is naturally limited. Foreign buyers from France and Germany are entering the market. This is the new economy. Old valuation rules don't apply. Every bubble in history deploys the same arguments. The specific asset changes tulips, stocks, real estate, cryptocurrency, but the psychological justifications remain identical. By January 1637, the mania had reached its terminal phase. New buyers weren't entering because they believed in tulips. They were entering because they believed in greater fools, someone more irrational, who would pay even higher prices tomorrow. This is the definition of a Ponzi dynamic. The asset generates no income, provides no utility beyond beauty, and depends entirely on finding a more optimistic buyer. Later, tulip bulbs don't pay dividends. They don't generate cash flow. They don't produce anything except more tulip bulbs. Their entire value rested on the collective delusion that someone would always pay more, and then suddenly they didn't. February 3rd, 1637. A routine tulip auction in Haarlem failed to attract buyers. The auctioneer couldn't find anyone willing to bid. Traders looked at each other nervously. Prices had always gone up. Someone always bought. That was the entire premise. But this time, no one raised their hand. Word spread through the tavern exchanges instantly. If buyers weren't showing up in Haarlem, would they show up anywhere? If prices stopped rising, what happened to all those futures contracts? Panic crystallized within days. Tulip prices didn't decline gradually. They collapsed vertically. Bulbs that had sold for 5,000 guilders the previous week couldn't find buyers at 500, then 50, then nothing. Merchants holding contracts for tulips suddenly realized they'd agreed to pay thousands of guilders for flowers. No one wanted. The greater fool had stopped appearing. The mechanics of the crash were brutal. Remember, most transactions were futures contracts, promises to buy bulbs that were still in the ground. These contracts had changed hands multiple times, each buyer paying more than the last. When prices collapsed, everyone in the chain faced catastrophic losses simultaneously. A weaver who'd paid 2,000 guilders for a contract expecting to sell it for 3,000 now held a worthless piece of paper. The merchant who'd sold him that contract was supposed to deliver a bulb he'd contracted to buy for 1,500 from a grower. That grower had bulbs in the ground worth maybe 10 guilders in a normal market. Nobody could fulfill their obligations. Everyone was underwater. The entire pyramid of leveraged speculation imploded. Courts were flooded with cases. Buyers refused to honor contracts, claiming they'd never actually agreed to such absurd terms. It was just tavern speculation, not real commerce. Sellers sued to enforce contracts, demanding payment in full. The legal chaos lasted years. Most contracts were eventually nullified or settled for pennies on the guilder. The Dutch government eventually declared most tulip debts unenforceable, recognizing that trying to collect would bankrupt half the merchant class. But the economic damage was done. Merchants who'd mortgaged their businesses to speculate on tulips lost everything. Families who'd invested their life savings saw their wealth evaporate. The interconnected web of credit throughout Dutch commerce seized up as tulip-related debts created cascading defaults. Contemporary accounts describe suicides, families fleeing cities to escape creditors. Respected merchants reduced to poverty literally overnight. The psychological trauma was perhaps worse than the financial loss. The Dutch had prided themselves on rational commerce, sophisticated finance, and sound business judgment. Tulip Mania revealed that even the world's most advanced traders could succumb to collective insanity. Here's my prediction. Every generation experiences at least one major financial bubble. Because human psychology doesn't change, just the asset being inflated. The specifics vary. The psychology remains constant: greed, fear of missing out, and the belief that this time is different. Let's see where the community stands. So what actually happened? How did rational merchants convince themselves that flowers were worth more than houses? The answer lies in human psychology specifically: cognitive biases that haven't changed since 1637. Availability bias: people judge probability by how easily examples come to mind. When everyone around you is getting rich on tulips, it seems normal and sustainable. You stop questioning whether it makes sense. 1. Herding behavior. Humans are social animals. When the crowd moves in one direction, individuals follow even against their better judgment. Standing apart from the crowd feels riskier than joining obvious insanity. 2. Recency bias. Recent events carry disproportionate weight in decision-making. Because prices had risen every week for months, traders assumed they would continue rising forever. 3 months of gains erased centuries of economic wisdom. 3. Confirmation bias. People seek information that confirms existing beliefs and ignore contradictory evidence. Tulip speculators focused obsessively on every story of someone getting rich, while dismissing warnings from skeptics. 4. Greater fool theory. Even participants who suspected the market was irrational believed they could profit by selling to someone more irrational later. This created a game of musical chairs, where everyone knew the music would stop eventually, but believed they'd find a seat first. But there's a deeper mechanism at work, something economists call information cascades. Here's how it works. Early adopters buy tulips for legitimate reasons: they're beautiful, rare, and prestigious. Their success attracts a second wave who trust the judgment of early adopters. This second wave's participation validates the market for a third wave, who don't evaluate fundamentals at all, but simply see prices rising and jump in. Each wave of buyers creates social proof for the next. Eventually, the market is dominated by people who have no independent information about value; they're just following the crowd. This cascade can persist for surprisingly long periods because each participant assumes someone else has done the analysis. Nobody wants to admit they're blindly following. The crash happens when someone finally checks and realizes the emperor has no clothes. Once doubt enters, the cascade reverses. Sellers trigger more sellers. Panic feeds on itself just as greed did. Tulip Mania also featured narrative economics, a term Yale economist Robert Shiller uses to describe how stories drive market behavior. The narrative around tulips was intoxicating. Exotic flowers from the East, beautiful and rare, owned by the wealthy, growing in value, making fortunes for clever traders, representing the prosperity of the Golden Age. That story felt true because it aligned with Dutch national identity. The Republic had defeated Spain, built a trading empire, pioneered finance. Of course, their flowers would be valuable. It fit the narrative of Dutch exceptionalism. Challenging that narrative meant challenging Dutch identity itself. And humans defend identity more fiercely than they defend logic. So what can we learn from tulips? Quite a lot, actually. Because every lesson from 1637 has been relearned painfully in subsequent bubbles. Lesson 1. Intrinsic value. Matters. Tulips produce nothing. They don't generate cash flow, don't create products, don't provide services. Their only value is subjective beauty and whatever price someone will pay. When an asset's entire value depends on resale price rather than productive use, it's vulnerable to speculation spirals. This applies equally to Beanie Babies, penny stocks, or certain cryptocurrencies. Lesson 2. Leverage. Amplifies disaster. Many tulip speculators borrowed money to participate. When prices collapsed, they lost not just their investment but went deeply into debt. Leverage transforms losses into catastrophes. The 2008 financial crisis featured the same dynamic over-leveraged positions. In housing, amplified a market correction into a global meltdown. Lesson 3. Markets can stay irrational longer than you can stay solvent. Some Dutch merchants recognized Tulip Mania as insane but tried to profit by shorting the market or timing the top. Many went bankrupt because they bet against the bubble too early. Just because you're right about fundamental value doesn't mean you'll profit. Market timing is nearly impossible, especially in manias. Lesson 4. This time is different is never true. Every bubble convinces participants that new circumstances have changed old rules. Tulips were rare. .com stocks were revolutionary. Housing would always appreciate. Crypto was the future of money. The specifics change. The delusion remains constant. Lesson 5. Regulatory structures matter. Tulip Mania occurred in largely unregulated tavern markets with no oversight, no transparency, and no enforcement mechanisms. The informal nature amplified the speculation. Modern financial regulations exist precisely because of historical disasters like Tulip Mania. When those regulations weaken or don't exist, like in crypto markets, bubbles form more easily. Lesson 6. Social contagion drives. Financial markets aren't just about data and fundamentals. They're about human emotion, social pressure, and psychological contagion. Fear and greed spread through populations like viruses. Understanding crowd psychology is as important as understanding balance sheets. Lesson 7. Recovery takes time. The Dutch economy recovered from Tulip Mania, but it took years. Trust had to be rebuilt. Credit had to thaw. Psychological wounds had to heal. After major bubbles burst, whether 1637, 1929, 2000, or 2008, economies don't snap back instantly. The damage lingers. But perhaps the most important lesson, humans don't learn. Tulip Mania happened in 1637. The South Sea Bubble hit Britain in 1720. The Mississippi Bubble destroyed France the same year. The 1929 stock market crash. The 1980s Japanese asset bubble, the 2000 .com crash, the 2008 housing crisis, the 2021 meme stock mania. Every generation thinks they're smarter than their ancestors. Every bubble is different this time. Every crash surprises people who should know better. Because the psychology driving bubbles, greed, fear, social pressure, narrative belief, is hardwired into human nature. Education can mitigate it, but not eliminate it. As long as humans can imagine getting rich quick, bubbles will form. As long as people fear missing out, manias will develop. As long as crowds think differently than individuals, speculation will spiral beyond rationality. I've covered the history, the psychology, the crash, and the lessons, but I might have missed something. What modern parallel to Tulip Mania concerns you most? What bubble do you think is inflating right now? What historical detail changes the interpretation? Historians, economists, traders, skeptics, all welcome in the comments. Let's crowdsource the complete picture. Because here's the uncomfortable truth that Tulip Mania teaches us. Intelligence doesn't protect against bubbles. Education doesn't inoculate you. Experience doesn't make you immune. The Dutch merchants who lost fortunes on tulips weren't stupid. They were sophisticated financiers operating in the world's most advanced economy. They had access to information, understood markets, and possessed business acumen. They still got crushed because they were human, and every subsequent generation has repeated their mistakes in different forms because we're all human. The question isn't whether another bubble will form. The question is, what asset will inflate next, and whether you'll recognize the pattern before it pops. Tulips taught that lesson in 1637. We're still learning it today. If this historical deep dive opened your eyes to the patterns connecting past financial disasters to present markets, hit subscribe. Because history has all the answers, we just keep refusing to listen. Check the description for academic sources, contemporary accounts of Tulip Mania, and analysis of how the same psychology drives modern market manias.